NVIDIA is one of the hottest stocks out there. It owns AI. At least that's what the market is telling us right now. Analysts are going crazy as they start to raise their price target. Investors want a piece of it, but it's $400 a share. This reminds me of the days when Google was trading in the thousands, Amazon as well. It's hard to actually go out there and invest in a stock that's got such a high price tag unless you use something that I use quite a bit in my portfolio. These are LEAP options, and we're going to talk about how I use LEAP options to get away from putting $40,000 into NVIDIA, but still control 100 shares. First of all, what is a LEAP option? Well, it's a long-term call or put option. So in other words, if I look at a front or back month, and these are all terms that you know if you've got the education and options, but if I look at something that's going to expire in the next couple of months, that's just referred to as an option, a call or put. When you go out beyond 12 months, out to 18 months, even 2 years from now, you buy what are called leaps. They're still calls and puts. They still operate the same way. They've got some benefits. They've got some drawbacks. But one of the biggest benefit is that it allows me to put less money into a trade to control 100 shares. Now, they're available on about 2,500 different stocks and ETFs and about 20 different indices. So a diverse collection of companies that you can invest in the long term by using leaps. As I mentioned, 12 months or more to expiration. They provide an alternative by minimizing or bringing down the allocation to each stock. So you can build a portfolio, an entire portfolio with leaps, and effectively be able to do it with a smaller portfolio. So you don't need $100 or $200 or $300,000 to have a diverse portfolio because of that much lower cost. You need to be educated on options and leaps. But again, if you like and subscribe this, we're going to help you along the way. That's what we do here. We educate and we give you ideas. So let's jump into my idea first by looking at NVIDIA. As I mentioned, this company owns AI. It owns AI so much that the stock is up 200%. Sure, there are a couple of companies that have exceeded that, but NVIDIA with its $1 trillion market cap is really the king. We talked about AMD just a couple of weeks ago, right here on our YouTube channel. And I told you that after they released their new chipset, AMD had kind of stretched their pricing, and maybe we were looking at a sell the news situation and an opportunity to pick up AMD shares cheaper. Now, Garrett Baldwin was talking about this morning, my colleague, pointing out that the stock has been flying high and has stretched its valuation, or at least its price valuation at the time, and he's expecting to see the stock pull back. I, too, am in the same camp. I think it's going to pull back from that $430 range right back to the level where I actually initiated this trade that I'm going to show you in just a moment. So around $380 to $390 would be a short-term opportunity to buy the dip. I just don't want to do it with $40,000. We're going to show you how to do that. So what is the benefit of the leap? Well, it's a lower cost. I've said that a couple times, but that's the big factor here. Once the options become in the money, you get to write covered calls, or you can choose to write covered calls. So it gives you the opportunity for income. Whereas if you wanted to write a covered call on the stock in your portfolio, got to have 100 shares. And we know I've already talked about that costing more than $40,000 on NVIDIA right now. You get the convexity or the leverage that options give you as compared to the stock. So a little bit larger movement, sometimes a much larger movement compared to just holding those 100 shares. You can still apply a stop loss strategy or a target price strategy by using the underlying price. Now, I'll point out that when we go down in price of the stock, the option's going to go down on a percentage basis more than the stock, especially if you're moving from in the money to out of the money. Get your options education to learn those terms, but you'll see a little bit larger drop in those situations. Gives you an opportunity to buy the dip again. I usually use that opportunity to dollar cost average into a leap when it gets down to a price that is beneficial for me, as long as I believe the stock is going to maintain that long-term trend. And as I mentioned already, you can provide income on this position just as you would 100 shares of NVIDIA in your portfolio. Here's a trade I'm looking at. This was about 2 weeks ago. Use this exact trade, initiated it as a synthetic position on NVIDIA. So at that time, NVIDIA is trading for about $395. So just below the $400 level. I was looking at the $420 level as that point where I really thought NVIDIA was going to start to get a little more momentum to the upside. It's exactly what happened. The stock broke out, ran to its highs, and now, as Garrett and I are both saying, it's time for the stock to pull back. But at that point, when I looked at January 2025, and they expire on January 17th to be exact, when I looked at those calls for the $420 strike, which was out of the money at that point, they cost about $9,525 for that one contract that controls 100 shares. Now, it's important to point out you can have splits between now and January 2025. These option contracts will adjust for those splits. So if the price comes down, your contract's going to be worth 200 shares instead of 100 shares on a 2-to-1 split, et cetera, et cetera. You don't have to worry about the option being affected by that. It moves right along with those corporate actions, special dividends, et cetera. It will replicate the stock from that perspective. So my goal here is for the stock to continue to maintain its trend. Let's call it 25% or so every time I look in on it. It's done 200% year to date. So I think over the next 18 months, that's a relatively conservative outlook, that 25% per check-in. And let's look at the first one. So we get 6 months from now, end of the year, beginning of 2024, where would this stock lie? Well, stock would be up about 24% with this at $49,000. So my $39,000 would have turned into $49,000. I'm doing okay here. 39 to 49. I'm doing pretty okay here. But my option, which cost me $9,500, has now turned to $14,500. 53% return versus the 24%. I like where this is going right now. And again, just have to maintain that long-term bullish trend. 6 months later, let's check in on July of 2024 using the prices. And if you're wondering, I use Black-Scholes model to put together the theoretical prices on these options. Most of the things being held constant except for the time to expiration and the price. So volatility, etc., held those constant. It's been very volatile now. So that actually helps in terms of the pricing to be a little not conservative, but realistic, let's say. On that July check-in, stock would be up about 55% if we just maintained that continued trend in the price. The option would be now at $21,600, well in the money at $612. So I could be writing a covered call on that leap option when every month, every couple of months. One thing I'll caution, and a lot of people talk about covered calls as a strategy. Always make certain the strike that you write, and again, get your education here, but the strike price that you write that covered call for is maybe not low. So in other words, with the stock like NVDA, if you go 5 or 6% out of the money, be ready to have those shares called away or this leap called away from you. That's the downside to writing a covered call. At the same time, perhaps you've already got 128% in returns and you're okay with that. But we'll continue. The 128% compared to 55%. I like the way the synthetic stock position is moving against the stock, leverage and convexity playing out. And again, less money in the trade so I can allocate. Going out to January 2025. So we play this out to the options expiration. 194% on the stock gets me at $76,562 for my original $39,000 investment. That's for the 100 shares. 363% turns into my return on the option using that price change in NVIDIA, that rally continuing. $34,500 is what it's worth. And remember, I put about $9,500 into this trade. What are the pitfalls? Well, as I mentioned, NVIDIA can suffer losses, and it will. Don't fool yourself in thinking this stock is going to continue to go straight up. That's what everybody thought when we hit the dot-com bubble. It does have risks to the downside, and the fact that it's a crowded trade accentuates those risks. So be aware of where you would have those closeouts, lock in profits if we start to see that volatility or trend change to the downside. The other side of this is, I don't know what the other side is. This is a great way to diversify a portfolio. As long as you maintain these trends, you keep a realistic outlook, use the same strategy with a company like Google or Amazon. It doesn't have to be a $400 company, or go after some companies that are way up there in the thousands. The stock strategy of using leaps as a replacement for the actual shares, especially if you want to buy 100 shares or round lot. This is the way that I'm going to go every single time. $100,000 portfolio, $200,000 portfolio. If I want to diversify, the synthetic stock approach works. That's it for today. Keep checking in with us. As I said, we're all about giving the education and the ideas to continue to beat the market. Have a great day. And as always, I wish you the best trading success.